Today, we're talking about investment strategies that you should make before the end of the year. So let's just dive right in.
The Retirement Readiness Podcast with Tim Regan and Katie Umland, presented by PrairieView Wealth Partners. Live your 2 life.
So today we're talking about getting towards the end of the year and some things that you should.
This is like the most riveting topic, right?
I know. Obviously, this is year 3, I think, of podcasts. So we've done this now 3 times. And so it feels like, oh my goodness, we're talking about this again. But every year, it's it's a thing that you have to talk about every year.
100%.
It changes every year.
It does. Yeah. Well, and what happens is because it just comes up once a year, sometimes people just put it in the back of their mind and don't think about it. And you never want to get to the point where you're sitting down with your accountant in March and you're like, I should have done that. Coulda. Yeah.
So today is the beginning of October. This airs in a few weeks. So it'll be more like the beginning of November.
Yep.
And then it's Thanksgiving, Christmas. Yeah. So it's really,
it's go time.
It goes really quick.
It does. Well, and what happens is a lot of times as you think about making a change, it doesn't just happen when you say, I made the decision. There's a whole process that stacks up, right? Do I have to open new accounts? Do I have to transfer money? December 31st at 2 p.m. You can't decide you want to make some decisions. This change. That's right. Yeah. Yeah. And so a lot of times, this is one of those conversations where we'll probably talk about a number of different items that may or may not make sense for anybody, but it should be a conversation that you're having with your financial advisor. And what we find a lot of times is people say, well, my accountant didn't tell me to do that.
Let me say what you're going to say.
Go ahead.
An accountant is rear facing.
Correct.
And a financial advisor is looking for the future.
That's right.
And so the accountant can only tell you things that you've already done and how that impacts. But a financial advisor is going to advise you on what you should be doing for the future.
Yeah. And occasionally you get the really kind of, it's a rare bird accountant that does both. But when you think about what the word accountant or accounting means, it means I'm looking at what took place and I'm accounting for it, right? It doesn't mean that I'm looking to say going forward, what's my strategy and all that stuff. And so this is usually a conversation that's best had with a financial advisor. And it's best had now. So like at PrairieView, our fall cadence is that we're doing, tax planning. And we're looking at what do we anticipate incomes to be this year? Or is there any type of strategy we should employ? And those strategies usually come in a number of varieties. And I'll kind of list them out and then we can talk about them maybe. One of them is, should I be doing anything with Roth IRAs? Another one is, should I be doing anything with tax deferred contributions? A third one would be, should I be doing anything with pooling charitable deductions or charitable gifts? Yes, you should be
closing your pool.
Oh, we just talked about that. We did, yeah. Well, at least if you're here in Chicago and it is end of the year, you should be closing your pool.
We're talking about something else.
Yeah. Sorry. Well, as we all say with a tear in our eye, right? As we anticipate winter
Close
coming.
The pool.
Yep. It's funny. So in our house, just as a brief aside, we usually try to open the pool. I'd like to have it ready before Easter, which when Easter's in March is kind of it's a lot.
Chilly.
But I like to have it open before Easter, and I like to usually close it the week before Halloween. Now, of that, you think, wow, April to October, that's a 6-month season. But you only swim in 3 months, right? Like it's a short season.
It just looks nicer.
But it's way better to look out. Yeah. Once you put that cover on and all the pool furniture comes in, it's like change of season. Yeah, for sure. And that's kind of how I feel when we start talking about taxes. I feel like this is not fun. But when you think about that forward facing or forward looking strategy, there are a lot of things that we can do, and I call it like picking up return on the margin.
Is that just what you call it? Just so casually came out.
So that's what I the way I think about it. So what I think about that is
say it again because I missed it.
So I call it picking up return on the margin.
Oh, okay. Picking up the return on the margin.
Yeah.
Okay.
All right. So what I mean by that is when you sit down and you think about your financial future, there are big picture things that you got to get right. How much do I have in stock versus bonds? Am I saving 10% into my 401k? If you're doing those things, you're getting 80% of the story right. And you're going to be 80% of the way to successful. But then there are these smaller decisions, and that's what I call on the margin, right? So if I'm thinking about this like pie, if you will, 80%, this big section is all about asset allocation. How much am I saving? What are my goals? Like just those big, don't spend as much as you make. Those are the big things. And then I get to the part that gets out towards the crust of the pie, and that's the margin part, right? Where on the periphery, there are smaller decisions where if I make those decisions right, I can pick up return on the margin, right? And so that's just in my mind where that phrase comes from or why I call it that. And so when I think about that, those are smaller decisions like Roth IRAs. I'll use one of our clients that we were just talking to yesterday. He unexpectedly was laid off in the summertime. He's close to retirement. It's fine. It's not one of those, hey, I'm 30 with young kids and what am I going to do stories. And so he and his wife will be fine. But because he was laid off in June, that means he has 6 months that he did not have the income that they were used to having.
Sure.
And because of that now creates a gap for us to do some planning here at year end. And that gap is doing some Roth conversions. So when you think about a Roth IRA versus a regular IRA, do you know the difference?
Oh, shoot.
Come on, I'm going to put you on the spot.
Okay. A Roth IRA is you are taxed on it when you take your money out. Or is that the opposite?
Opposite.
Okay.
Yep.
So a Roth is when you're taxed when you put your money into the.
Yeah, 100%. So with a regular IRA, and when you think regular IRA, think like your 401k can turn into a regular IRA. So when you hear that, the money that you put in, you don't pay tax on. So you get a deduction off of your return, off of your tax return, that is. So you save taxes there. It grows tax deferred. And then when you take the money out, that's when you pay tax. Mm-hmm. With a Roth, the money you put into it has already been taxed.
Okay.
But it all grows tax free. And when you take it out, it's still all tax free.
Okay.
And so one of the strategies that we start to look at here at year end is how far am I from my next tax bracket? And do I have room?
Max that out.
That's right. Do I have room that I could do a Roth conversion where I will pay less in tax today than if I postpone it all the way until retirement and take it out?
Sure.
And so now I can kind of play with that and say, let me get some tax-free money when I'm in retirement. So one of the things that you should be doing is taking a look to say, do I have any room to do any of these Roth conversion type of moves? And is that something that, Katie, you were hoping we were going to talk about?
Yeah, that has been itching at my brain. I was like, we need to talk about the conversions here. End of year.
That's right.
So when I think of end of year, I think of QCD. Because that I feel like is always coming up at the office.
Look at you calling out QCD.
Yeah.
And now do we know what QCD stands for?
I knew you were going to say that. Qualified charitable distributions.
That's it. Yeah, that's it. Yeah. So 100%. So a lot of times what people don't think about as they get into retirement is how can I give to church? So, and I say church, it could be any charity. It doesn't have to be church, but what happens is I get used to every Sunday writing a check and putting in the offering plate, or I get used to the auto draw that comes out of my checkbook. But when you get over the age of 70 and a half, you have the opportunity to now do what are called qualified charitable distributions, where you can say, instead of me writing the check, I'm going to have it come directly out of my IRA or my retirement account and go to church. The benefit there is right now, most average people are not itemizing their deductions. Mm-hmm. They may be remembering, most people remember back probably 8 years ago when they did itemize, they said, I'm going to take off my property taxes and my charitable deductions and all that stuff. I'm going to itemize my deductions. But about 8 years ago, there was a shift in the tax law that raised what the standard deduction is. And so the way taxes work, just as a brief maybe education for some maybe that aren't familiar with it, the way taxes work is you have your income that you have to pay tax on. So let's say I made, for simplicity's sake, I made $100,000 this year. Well, I get to deduct for expenses that the government says you don't have to pay tax on that part of your income. That's where the word deduction kind of comes from. So if I start at 100,000, they automatically say you get this much as a deduction. That's the standard deduction. So you're not going to pay tax on 100. You're going to pay tax on something less than that. And that changes whether you're married or single or whatever. So there's lots of things but just everything works the same. It's just the actual numbers might be different. So I have 100,000. I can take my standard deduction. Well, if I have other things that I've written checks to that will qualify as a deduction, and all of those checks add up to more than the standard deduction.
Oh, you get that.
Then I get to choose to itemize my deductions versus taking the standard. Well, what's happened is they raised the standard deduction a number of years ago to the point where most people don't qualify to take itemized deductions anymore. Just the way that things were changed, they just don't get to do that. And so what happens is we have a lot of people that think because they don't necessarily, they count on their accountant to do their tax return. They don't dig through and understand all of the intricacies of that. They still think that that money they're giving to church, they're getting a deduction for, but they really are not.
Okay.
And so what happens is when I turn 70 and a half, I can now choose to say, instead of me writing the check to church, take it right out of my IRA.
Yeah.
And if I do it right out of my IRA, if we go back to what's an IRA versus a Roth IRA, that IRA means I put it in, I never paid tax on it. When I take it out, I have to pay the tax. Well, if I give it directly to church, there's no tax owed because it's going directly to a charity. And so what I've done is I've eliminated the tax I would have paid. So a lot of times people say, I take, $2,000 a month out of my retirement account to support my lifestyle. That's great. Maybe though, let's take only $1,000 a month and give the other $1,000 to church rather than you writing that check every week to do it.
It helps everyone.
It helps everybody. Yeah. And so I don't know if you were expecting this to be a teaching lesson when you said when you brought up QCD.
We need your whiteboard.
Yeah. How about it? And so there's a lot sometimes to unwrap there. And so what I tell people is, don't worry about the detail. I mean, if you want the detail, we can give you the detail. Don't worry about the detail. Just know that right now there are things that you can do before the end of the year to reduce your tax burden over time, so that you're in a much better position over the course of your life. And let your advisor tell you, figure it out. I always compare it to taking my car to the mechanic. I am mechanically declined, right? Instead of inclined. And so, when they tell me we're going to replace your part, whatever that part is, I don't care that they're going to use a 3/4 inch socket, and I don't care that it's got to be torqued to this poundage.
Just
and I don't care. Just tell it makes sense to me. Go ahead and do it. And that's what it should really be with your advisor, right? Your advisor should know all of those intricacies and help you to see, hey, here's what it's going to mean for me long term.
I think that is a good kind of distinction, like you said earlier, with your accountant versus your financial advisor. I think when, like you mentioned, people think that they're getting deductions, but they're not. Your accountant doesn't know that you go to church.
Sure.
You think that your accountant is thinking of all these things for you, but you kind of have to take them to your accountant.
Exactly.
And if you don't know what to take to your accountant,
how are they going to
know?
No, 100%. And
I think that can be frustrating, and also you don't think about it.
No, 100%. Well, and it's funny you say that, because it's actually why, maybe this is premature, but, it kind of came up, PrairieView is getting in the tax business, because of that very thing. It just
makes so much sense that your advisor would also work with an accountant in some manner.
100%. Yeah. And so, and we've seen that as a gap. And what's hard is that the accountant doesn't necessarily know who the advisor is. The advisor doesn't always know who the accountant is. The two of them don't necessarily have a sign off by the client to share information.
Right.
And so from our perspective, and, it just makes sense. And so that's why, starting in 2025, PrairieView tax will be a thing, and will hopefully help to bridge that gap where we can give more holistic and full advice, and let that carry through to the tax return, to make sure that we're giving people as good of advice as we possibly can.
That's awesome. I think that just makes so much sense, not just for PrairieView, but financial advisors in general.
Yeah. No.
I mean, it's in every conversation, both are being brought up.
It is. It totally is. And so the way that I had an accountant tell me one time, and it makes all the sense in the world. There's two parts to accounting. There's compliance and then there's advisory. Compliance is I'm doing the things that I need to, paying the tax I need to, checking the boxes I need to. Advisory is now that I have all this going on, how do I get advice around how do I make the tax code work for me in my situation? And too often people don't get the advisory side. They only get the compliance side. And so the gap that we've had at PrairieView is we've had the advisory side. We never had the compliance side. And so now by bringing those two together, it'll be well, and better. It's
also hard. I know that it's like, you're sitting down with a client and you give them like, oh, take all this to your advice or take all this to your accountant or ask all this to your accountant. Well, now it's passed to the next person and then you have to rely on them to bring it to their accountant.
Yeah.
There's a lot of middlemen and they forget what they're supposed to ask 100%. Or they don't understand what they were really supposed to ask. And now that gets lost in the shuffle. And so that kind of takes all that guessing
we
out.
call that Rachel in the office. She always calls it getting lost in the sauce.
Yeah, right? Exactly.
Because it does. It gets lost in the sauce.
Too easy.
So
is this turned into a press release?
I think
we just made an announcement that we didn't mean to.
It did not mean to. Yeah. So we are still. It is still early stages. The anticipation is that we'll be up and running prior to next tax season, starting in January. And we do have experience on the team in this area, so it's not like, hey, let's start from scratch. I mean, this is something that. We have some folks that are really talented on the team that are good in this area. So, well,
it's not something that is a new thought.
No, correct.
It's been on your mind for.
It has been in the works. It's just newly being kind of mentioned now. Yeah, and so, so we talk a little bit about QCDs, which we can look at here prior to year end. We've talked a little bit about what happens and how can I do like a Roth conversion and take advantage of the tax bracket that I'm in. And when you think about tax. So let's just kind of talk a little bit about why those two things, why it's different, compliance versus advisory. So on the compliance side, you will always look at what's to this year and how do I comply this year. And typically when you talk to your accountant, they're going to look and say, how do I reduce your tax this year? The problem is this year is 1 out of 100 this years that you're going to have in your lifetime. And so what we really need to be looking at is how do I save tax over the course of my life, not over the course of the investment, whatever, not how do I save tax this year. And so when we start looking at it that way, you can actually then add to that. There are ways that we could be saving tax for your children when they inherit the money. So now we're really looking at an investment that could span not the next 40 years of my retirement. It could span the next 80 or 90 years while my kids are using that money too, or grandchildren. And so that's really where this comes in and why it's important to have that conversation now versus after January 1st. But another thing that we look at, we've got a client right now who is going through, again, he's retiring, it's planned. But because of the way his deferred compensation structure is and his stock options and some of those things, he's going to have some really high income this year and next. And so one of the things that we're working on with him is what you call bundling your deductions. So I talked about this standard deduction versus itemized and things. So in their case, what we're doing is we're actually front loading all of their charitable deductions for the next 5 years. We're putting it into what's called a donor advised fund, which means that it's not money that's going right to church this year. They're putting it in. It's in a fund that they get to advise on and say, over the next 5 years, we're going to be giving this to church, but I get to give it all this year. So when my income's really high, I get a much larger deduction, which brings me down the the tax bracket. And we'll probably do the same thing next year.
Sure.
So he'll end up ultimately front loading all of his charitable deductions for the next 10 years because his income is in such a higher place today than it will be going forward, because of just how things are working. And so there's those types of things that also
interesting. You would never know to ask about.
Yeah. Well, and what happens is it falls into those categories of, you hear different times you might hear people say, there are things that I know.
Exactly.
There are things I know I don't know. And then there's those things that I don't even know that I don't know.
Scary group that is things you don't even know.
That's right. Yeah. Like it's always funny to me. The things that I know I don't know. I know I have no idea how this podcast airs.
Yeah. Right.
I don't like how is it possible that we can take video and audio
in Frankfort, Illinois
and stream it across the globe?
Right.
Like instantaneously.
Right.
Like I do not understand that. I don't know that I will ever know that.
Right.
But then in that category of things I don't even know I don't know, like you said, that's the really scary part because you don't even know to ask the question. And that's why whoever your advisor is, we say, sit down with the advisor before it gets to the end of the year.
Give them time to do the work on it.
Absolutely. Absolutely. Yeah. And
before it's their Christmas and Thanksgiving too. And things are.
Yeah. It's just hectic, right? Just busy.
Yeah.
And have the time to put thought into it, right? Because there's a great book. I feel like every time we talk about great books. But there's a great book. It's called The Road Less Stupid. And the whole concept is don't get into life just like hard charging and running. Take time, stop, ask yourself questions, think about the answers, and be intentional. And what can happen is if we push things to that deadline, when it comes to things like our forward-looking planning, I can give you ideas off the top of my head, and they're probably good ideas when it comes to this, because this business I know, right? But if I sat with it for a week and played around with it for a week and had my mind working on it for a week, I might come back with a different, better answer. Yeah. And so take the road less stupid. Give it some time.
That is a hard line to cross, though, because also you don't want to sit on it for 3 weeks.
Yep.
And keep ruminating on it too.
Correct.
That's the spot Alex and I always find ourselves in of, okay, let's make a good decision, but let's also make the decision.
Yeah. No, 100%. Yeah. And there are those things like they always say that when you get towards the end of your life, you regret the things you didn't do more than the things you did. Right. And so make the mistake aggressively, make the mistake moving forward. But also walk the line of saying, I'm not going to be flippant about it. I'm going to be thoughtful about it. Which is, one of the things we talked a little bit about the book coming out here at the end of the year. One of those things, one of the chapters in the book really talks about how your brain works. And if you ask your brain to solve a problem, it will keep working on it in your subconscious. While you sleep, when you're awake, it will keep working on solving the problem. If you tell your brain something, it stops thinking. So, and you can try this with anything. The example I like to think about is, Katie, if you got up this morning, you and Alex decided you wanted steak for dinner tonight, and you said to yourself, oh, when I go to the grocery, I need to pick up steak. You'd write on your list and you would stop thinking about it. If instead you said to yourself, what kind of steak do I want tonight? Or where should I get steak tonight? All of a sudden your brain would start thinking about, well, the grocery store, Walmart, Costco, the butcher. Your brain would start thinking about, oh, wait, I think I saw a sale at this store versus the other store. Maybe I'll go to Mariano's instead of Jewel because I saw the sale. Or you might even think, wait a minute, New York strip. I like New York strip wherever, but if we want filet, I want to go to the butcher and get it cut from, and your brain just did that because you asked it a question instead of giving it the command of, I'm going to do this. And so, and what you would find is probably, so that happened this morning. Then at 2:00 in the afternoon, you'd be like, oh, wait, no, I want, because your brain
makes sense now.
It's trying
That is so interesting. It can be good and bad because that's also why you feel relieved when you have so much on your mind and you make a list.
Yes.
because you're done thinking about it.
You're not solving the problem anymore. It is out. It is done. Shut off.
And you feel overwhelmed easily until you start doing that. That's so interesting.
And the same thing happens. Like, that's why you go to bed at night and you have this like thought on your mind. And then you wake up in the morning like, oh, that's what I should do. It's because your subconscious was working on it, trying to solve the problem while you're sleeping. So how that applies to tax planning at the end of the year is, you really need to have that time to sit with it and let your mind and let your advisor's mind work on what should we be doing and what are some of the things that we could be taking advantage of. Otherwise, you might get to the end of the year with the shoulda, coulda, wouldas and missed an opportunity.
Interesting. So
we always come back full circle.
I know, eventually.
It's wandering, right? Yeah.
So in addition to getting your holiday planning ready, now you also need to do your taxes.
Yeah. Close
your pool. Yes. Make your Christmas list and do your tax planning.
Well, but if I'm like you, it's buy a house with a pool.
Right? First buy the house, then close it.
Yeah. And so you and Alex just closed on a new house.
We did, new Lennox. So
awesome.
Moving a little bit closer to mom and a little bit closer to things.
Well, the center of the world, which is Frankfort, Illinois, right?
Obviously.
And so new house, new pool.
Yep.
That's exciting. Kids got to be. Does Dylan realize like that's his pool yet?
He's starting to understand. He's so funny. So our realtor is Dave Cobb. He's been on the show a few episodes ago. And so every time we've gone to see the house, Dave's been with us to show us the house because he's our realtor. So we get to the house, we closed, and I take the kids to see the house where I was grabbing some things. And I said, oh, Dill, we get to go to our new house. And we pulled up and he's like, Dave's house. So now our new house, he thinks is Dave's house. And every time we talk about it, he's like, Dave's house. I'm like, okay,
we're going to Dave's house. So Dave. So when Dave watches this episode, he now knows that he's the one that has to come in back in the pool every week.
Did you hear that, Dave? It's your house.
Yes.
We also are selling our current house, I guess. So we have a big for sale sign in our yard and has Dave Cobb's picture on it. So every day, Dylan and Quinny have to go out and say hi to Dave. So Dave's a major part of our life right now.
That is hilarious. That's so funny. Yeah. So when Quinny asks Dave to walk her down the aisle when she gets married,
I know we're getting a little encroached in on.
Yeah. How about it? Yeah. Hopefully it's funny. It's funny to think about kids, how that stuff is, right? And then you wonder how much of that lingers. Because like when you think back to, I listen to our kids talk about stuff and they remember things from their childhood. And like,
you're like, it wasn't a big deal at all.
Yeah. But they're like, remember we always did this?
Right. Like 2 times.
Yeah. I remember that.
Exactly. Yeah. Right. And he's just starting to get to the age, like he might remember. Like brief. Parts of this.
It might be a flashback type thing. Yeah.
So all good things. But in typical Alex and Katie fashion, we do everything kind of all at once and things are kind of crazy for a while and then they'll settle down and
then you'll decide this is boring.
Be the next
we have to do the next thing. Yeah.
So hopefully we have a track record of moving every 2-3 years. So hopefully this one is.
Well, it's a beautiful house. And like you said, closer to mom. So
closer to everything.
Yeah.
So be good.
Mostly mom. Yep. So awesome. Great show.
Thank you for joining us today. For more resources, head to the website, pv-wp.com.
The Retirement Readiness Podcast with Tim Regan and Katie Umland. Presented by PrairieView Wealth Partners. Live your 2 life. Learn more at pv-wp.com. And while you're at it, don't forget to subscribe to the Retirement Readiness Podcast on your preferred podcast platform.